Thanks, Mike. I think one way that we think would be helpful for the group to start off is to turn it over to Tom Munster and just give a primer on the space, his interactions with advisors, investors, and platforms over the years, being that this is now phase 3 of what we call the income ETF experiment, and his excitement around the rollout of these products.
Yes. Hey, hi. Thanks, Mike, and for the opportunity to speak with your members. I am excited to introduce these two fellows. Jonathan has been a pioneer in the options-based income and actively managed ETF space. As you know, he's been in the industry for 20, but been doing this for over 10. And his background is in the hedge fund space, and that is my background as well. I've been speaking with family offices and IRAs for nearly 4 years about these products, and the acceptance and utilization has been impressive, to say the least. There's very, very few places to go for uncorrelated income, and that's relatively stable. We continue to have different iterations, and STF Management is about to show you the newest and most dynamic that I've seen in the space. It really is amazing to me that the ETFs in general have allowed the rules have changed so that we can do more sophisticated modeling, better portfolio management for the Wall Street, the Main Street people. I've spent my career with the Wall Street personnel, and I'm just delighted to see something of this quality able to be distributed to RIAs, families, and individuals. So I can't say enough about the team. I know that you'll enjoy speaking with them, and the next 30 minutes or so will be a very good use of your time. I'm always here to talk about them and to facilitate, direct meetings. So on that note, I'll push it over to Tom and Jonathan.
Thanks, Tom. So, Michael, do you want to share the deck, or would you prefer if we do?
I would prefer if you do. I do have a backup copy on my side, but if you'd like me to do it, I will be happy to do it. I just need you to prompt me when it's time to actually move the slides.
Sure. So why don't we let you drive?
All right. Okay. That's easy enough. All right, I'm just getting it up here. All right. There we go. Okay, can you see that?
Yes, sir.
Perfect. Go for it.
Okay. So if we move forward a slide, for those of you not familiar with our firm, STF Management is a SEC-registered investment advisor headquartered in Frisco, Texas. We set out with a goal as a solutions-based ETF issuer to solve for the two pervasive challenges facing asset allocators, which are, one, remaining fully invested in all market cycles while providing consistent high income. Our team is comprised of a variety of industry professionals who have specific expertise in financial services, to include hedge funds, investment banks, insurance companies, and asset management firms. Our team is dedicated to bringing core portfolio investment solutions to clients, leveraging our experience in product development, portfolio management, and distribution. In addition, you may be curious what STF stands for: simple, transparent, and focused, which are the core drivers behind the firm's investment approach. So if we move forward again. So why we're here today and what Tom had touched upon is what I call the ETF experiment. Since the 1990s, there have been thousands of ETFs launched, traditionally vanilla beta, long only, very passive. And in recent years, you've started to see the ETF industry become more in line with alternatives and more open to active strategies. So, over the course of the last 10 to 20 years, both ETF investors and issuers have faced these numerous challenges. And what ultimately has happened is numerous alternative income strategies to help investors supplement their income despite a long-term decline in interest rates. More so in relevant times, how they're navigating the heightened volatility within their traditionally risk-off fixed income allocations. So over the course of the past decade, what we've seen is passive starting to traffic into active. And as they've gained traction in their incremental alternative offerings, both institutional and retail outlets have continued to adopt these. And these have now really started to show their value proposition as solutions-based strategies. So if we're looking at this visual, roughly 10 years ago, one of the more popular income strategies came out, and it was a passive underlying, passive option, covered call product. It generated monthly income. It gave people the same core exposure that they already possessed in their portfolio, but now they could achieve income alongside that exposure. A few years ago, we saw, again, a passive underlying come out, but with an active strategy on top, which again, seek to generate monthly income, but with a measure of downside protection. Now, in 2022, two new strategies have emerged from STF. And now we find ourselves 10 years later where the number of options-based strategies or high income options-based strategies have grown from single digits to well over 200 funds. Now, these new strategies showcase the value of active tactical asset allocation. That's the underlying. This is the same core that people are seeking in their current investment accounts. So one of the strategies does that with a rules-based active option overlay, which seeks to generate high current monthly income to support the payment of a monthly dividend. Phase 3 in the evolution of options-based ETFs is now here in the market today to solve for the two biggest challenges investors have and will continue to have. Again, remaining fully invested regardless of market conditions while maintaining a suitable risk profile. 2, generating a consistent stream of monthly income without onboarding many of the associated risks with traditional fixed income. We are now at the point in the ETF industry where an active underlying and an active overlay to provide income has now presented itself as a solution to all investors. So if we keep moving forward, we can get into the products. So the first product, the ticker symbol is TUG. And TUG stands for the model that powers it. TUG stands for Tactical Unconstrained Growth. It's an active quantitative approach to tactical asset allocation. The strategy allocates between the NASDAQ 100, treasury bonds, and bills, along with cash given certain market conditions. The program behind the model is quantitative and data-driven. This removes human emotion and bias from the investment experience. This also affords investors a more proactive than reactive approach. What does this do? Well, it helps avoid costly mistakes associated with attempting to time the market and or capitulating due to uncertainty and high market volatility. This strategy truly seeks to enhance the core exposure most investors possess in their portfolios while providing the optionality to play both offense and defense regardless of market conditions. Lastly, all of this is packaged in one product within the ETF wrapper, affording investors the potential to increase tax efficiencies while potentially decreasing the costs associated with deploying a similar tactical strategy on their own. And to take that a step further, within the ETF wrapper, one click will allow an investor to own this strategy. They no longer have to worry about all of the buys and sells that go into the strategy and or the tax implications of all of those buys and sells. So you receive all of this in a fund that launched in May of 2022. Now it currently is up to roughly 150 million in assets under management, and all of this for only 65 basis points annually in a management fee. So why don't we move forward and look at the next product, TUGN. So like TUGN employs the same active quantitative approach to tactical asset allocation with one twist. It also incorporates a monthly option overlay strategy, which seeks to generate high current monthly income to support the payment of a monthly dividend. The option overlay utilizes a 1 month to expiry NASDAQ 100 call spread. It sells the call spread. So with this approach, it will sell a near at the money NASDAQ 100 index call option while simultaneously purchasing a further out of the money NASDAQ 100 index call option. This strategy generates a net credit, which in turn supports the monthly dividend. Now, this also can potentially reduce the potential for the portfolio being capped in a rapidly rising market. Many of the issues associated with covered call strategies, specifically passive ones that do not have the ability to remove the short call prior to expiry to allow the underlying assets to grow alongside the portfolio, the market, and increase upside participation. Now, the overlay is reset or rolled on the 3rd week of every month around options expiration. And now, given the active rules-based program, the options are able to be closed out, as we just previously mentioned, prior to expiration to capture gains and or minimize losses dependent upon market conditions. TUGN launched in May of 2022, is now up to roughly 25 million in assets under management, with an indicated yield in excess of 12% per year. This is all while charging a 65 basis point annual management fee. Now, I know that when many people hear options, they think of leverage. This is not always the case. Options can be used for 3 reasons. 1, yield enhancement. 2, hedging and or downside risk mitigation. Or 3, leverage. In the case of TUG, options are used for yield enhancement and to potentially dampen volatility. These are 2 great new product offerings. So now let's take a deeper dive into the mechanics of the 2 strategies. And there I will hand it off to Thomas.
Great. Thank you very much, Jonathan. We'll go to the next slide. We're going to begin by looking at the active component, the difference between the prior versions where you had passive basis. We're going to look at the active base, and we're going to take a look at the principles that undergird our active approach. What we're going to start with is what I consider one of the most important modern assumptions in investing, that a passive exposure to equities is a requirement for a buy and hold approach. Now, this ends up being true in both portfolio construction as well, to be more specific, those prior generations of option-based ETFs. The following is a picture of the NASDAQ 100 looking at the daily closing prices from January 2000 through December 2015. Now, that high water mark over on the left-hand side is just over 4,700 and occurred on March 27th. Michael, if you'll hit one more time, we have a couple animations on this slide. So what happened is immediately afterward, the index lost almost 83% of its value over the next 2.5 years. Again, it would not close above 4,700 until November 2015. So go ahead and advance the animations just a bit for me. Now, as a passive buy and hold investor during this entire period, every single day that you're looking at this is a buy, every single day is a hold. There are literally no days when you should have had anything less than 100% exposure to this index. Now, in my mind, this fails the eye test, as well as the investor behavior test. Most investors are not going to hold through an 80% loss and then wait 15 years just to break even. If we can go on to the next slide. That's the animation. We'll go one more, please. Thank you very much. So this is the familiar slide, or it should be. Now, again, in the past, what you'll see is this analysis done against the S&P 500, but we're talking about the NASDAQ 100. So we recreated it. And again, what we're going to go off and take a look at is from 2000 through June of 2022. Again, very familiar. This is the common defense for the passive approach. And again, we have all seen this type of research. It demonstrates that what happens to your investment returns if you miss any of the best individual percentage days. Now, again, take a look at the top. That's the base NASDAQ 100. A dollar becomes $2.58 over this period of time. Now, what's interesting, if you've missed the 10 best positive daily returns from January 2000 through June 2022, you end up forfeiting more than 50% of your cumulative returns in the NASDAQ 100, just 10 days. You miss the best 20 daily returns, and you end up with a cumulative loss of 30%. Wow, that's the conclusion of the industry, of course, is what? You must always be invested because you cannot afford to miss 20 days out of, in this case, 5,660 individual opportunities to make gains. That works out to that all of your returns depend on just 0.35% of the investable days over the last 22 years. Pretty strong case. Let's go to the next slide, though. What they never show you, in my mind, is this analysis. This is the reverse of the premise. And this time we're asking, what if you miss the 10 worst days from an investment perspective? It should not be too surprising that you would, of course, do better. You're missing out on the worst days, but you more than double your cumulative return. You miss the 20 worst days and you have quadrupled your cumulative returns. The question that this raises in my mind is, why is this never included in the passive always-on equity materials? So we'll go to the next slide. Let's put it together like this. What if you could invest like this was an Olympic figure skating competition? You know you have to throw out the best and the worst scores because of bias. So if we do the same thing with the NASDAQ 100 index, what happens? Well, notice that black line down at the bottom is our original $2.58. If we eliminate the 10 best and worst days, you get all of your returns plus a little premium. Eliminate the 20 best and worst days, you get all the returns plus a little bit more premium. What's the conclusion? Well, by removing the extremes of the market, what we would often call tail risk, we reduce the emotional tendency of the investor and advisor to either chase performance or capitulate. But again, maintain all of the returns of that long always passive approach to investing in equities. Importantly, I think we increase our immunity to the emotions of fear and greed. As we move to the next slide, the question now becomes what? Can we turn that principle, eliminating the extremes of the market, into a practical investment strategy? The answer is yes, using the TUG model. Now, for brevity's sake, I'm not going to cover all the information on this slide. And please note, a copy of this presentation is already available on FLIA's website. And again, we have a website we're going to we're going to show at the end. And if you've got more questions that you could not answer or didn't get a chance to engage with us here, we'll show you how to get involved with us later on. So don't worry about everything that's on this slide, but we're going to focus on really three important things. We're going to begin with this lower left-hand side. The TUG model uses basically a series of moving averages, relationships, and a proprietary volatility metric to choose from among three fixed asset allocations. If the market is in a strong buy, the ETFs should be 100% exposed to the NASDAQ 100. You have to be invested in the market to make money when it's going up. When the markets are a buy, meaning they're bullish, but either in a transition or there is some demonstrable weakness in the NASDAQ 100's price action, then we go to a 50-50 exposure, balance between equities and fixed income. Finally, when the market represents too great a risk to invest in, we then hold our full allocation of treasuries, which is 90% of the portfolio. The ETF is positioned in fixed income. This is more appropriate. So as the arrow in the middle indicates, the TUG model seeks to shift between equity and fixed income positions depending on the prevailing market conditions. Well, let's focus our effort now on the chart on the bottom right. The black line, again, is the daily closing prices of the NASDAQ 100. This time we're looking at just a 2-year period, 2000 and 2001. The TUG model signals are indicated by the 3-color positions, where a strong uptrending market is represented by the double blue columns. The bullish, but not overly enthusiastic periods by a single blue column. And then finally, when you see no element or a red column, these represent periods where avoiding equity exposure reduces risk and attempts to preserve capital. Now, hopefully, as you quickly examine this chart, you'll concur that the TUG model's fundamental allocations appear to be correct. In case you're wondering, all of this is algorithmically driven. This is, again, not a model where the advisor and the investors are counting on the acumen of the portfolio managers or the team. We run this every afternoon prior to market close. The system takes its inputs and then basically provides a signal. Any changes are reflected in the ETF positioning at the close of the market. So you and your clients begin the next day in the resultant allocation. You are set up for tomorrow. More about how that TUG model works across US equity indexes and even some sectors of the market will be available in a white paper, Investing in a Fishbowl, that should be out later this month. Again, more about how to get that report at the end of this presentation. On to the next slide, please. So let's turn back to that prior analysis where we discovered that eliminating the extremes of the market should be beneficial to the investor. Now, the question is, does the TUG model, the rules and the algorithm, offer a true risk managed asset allocation to investors? The answer is yes. In a blind application of its tactical rules, the TUG model eliminated from exposure 80% of the best and worst days in the NASDAQ 100 since 2000. The remaining days have only partial exposure. Now, again, note the symmetrical nature. The best and worst days are basically treated equally by the TUG rule set. Again, removing the best and worst 10 or 20 days from the NASDAQ 100 results in slightly improved performance, but without the volatility that drives investors to capitulate. TUG's tactical management helps the advisor and the client maintain their investment posture without the emotional responses of fear and greed. And finally, before we leave this page, sometimes life hands you a rare recent sample. On Monday, the loss of the NASDAQ 100 would have qualified as the 15th worst percentage loss on a daily basis going back to January 2000. Monday's allocation from the TUG model, maximum defensive, 10% equities, 90% fixed income. This would have been another miss due to the rule set. Next slide, please. Jonathan?
So given that we were just, Thomas was highlighting the adaptability of the strategy and how it's nimble and the proactive approach to sidestepping the erosion of your principal balance based on outsized market moves, I want to now talk about volatility and income and how when these two combine, the true value that they unlock for the end user. So what we see here is how TUG provides similar risk exposure to bonds. It can potentially exhibit less volatility than a traditional 60-40 portfolio. And that would be comprised of 60% S&P 500 and 40% of the Bloomberg Aggregate Bond Index. Another point to mention is how much lower TUG's volatility is relative to both the NASDAQ 100, as well as a blended portfolio comprised of, say, 70% NASDAQ 100 and 30% Bloomberg Aggregate Bond. This is not a product that should be thought of as a NASDAQ 100 solution. This should be thought of as a portfolio solution. Most portfolios contain stocks and bonds. But how do you get to stocks and bonds while still lowering your portfolio volatility so that you know you're on the right track to your investment outcome? Well, to recap here, similar exposure, less volatility. If we move to the next slide, what we'll see is where does the income version of TUG, also known as TUGN, fit into a balanced portfolio? We previously talked about the search for alternative income strategies over the past few decades. And the emergence of MLPs, preferreds, the desire of investing in high yield bonds. So let's take a look at this chart and take a deeper dive here. So if you can generate the net credit on a monthly basis to support the dividend payment of TUGN. Now, what's incredible about this is the traction in which options-based income-oriented strategies and how they've gained course over the past decade. And what comes of an options-based income strategy is reduced correlation to traditional fixed income, as well as the minimized exposure to duration and credit risk. And here what we can see is how it compares to other alternative income strategies such as REITs, MLPs, and you see how it still possesses the ability to generate a net indicated yield, which is far more than these soft, often sought after alternatives. So we highlighted the lower volatility profile of TUG, and then you package TUG with a higher income generating version, which is TUGN. And so now we're going to ask, where does this ultimately lead us? So if we move to the next slide, what we see here is that TUG provides quite a solution for asset allocation. It has the potential to naturally lower risk while remaining fully invested. And this is incredibly valuable in an alternative income strategy, in that you no longer must worry about the cost of carry for a hedge, missing out on upside participation due to a passive approach, or maybe more importantly, taking on more risk when you're seeking to de-risk. And as was mentioned prior, capitulating and exiting the market entirely. And then now it's on you to figure out when to re-enter. What this chart is showing us here is how TUG plus income truly stands out from bonds, commodities, and alternative income strategies. Showcased here are how many units of yield one receives per unit of risk they onboard, given their investment choice. Let's water this down. We can think about how investors evaluate Sharpe ratios to determine which investment provides the greatest risk-adjusted return. This is quite similar in that we are looking at how much risk are investors taking to generate and secure a stream of income to make up for lack of yield in a portfolio, given the current state of traditional fixed income. So if we move forward again, we can summarize all of this. So by getting risk-managed tactical asset allocation through the TUG model, combined with the yield potential from an active options overlay, investors can maintain capital growth potential while generating uncorrelated and consistent monthly income in a tax-efficient ETF structure. One thing I really want to point out is that TUGN distinctly triangulates the asset allocation, income, and tax efficiency solution all in one product. So investors should consider TUG and TUGN as a core investment product in addition to income supplement. A few points to leave this group with today are risk-adjusted asset allocation that takes emotion out of investing, hedged equity alternative with a bent towards long-term growth of capital, index options as a non-correlated source of monthly income that are also tax advantaged to single stock options, active call spreads to dampen volatility and adapt to current market conditions. And both strategies are packaged in the tax-efficient, publicly traded fund wrapper of an ETF. Now, based on the model, Thomas and myself can adjust the allocation while minimizing capital gains implications and trading costs that an individual investor would incur. One last point I want to leave the group with today is that though the ETFs may be new to the market and are 4 months old, this model and these strategies have been run for quite some time. And it was due to the client demand in other wrappers that these strategies were offered that led to the birth of these two ETFs, and which will drive the demand for additional products going forward that offer different exposures, but all follow the TUG model. The beautiful thing about the TUG model is that you can think about it as a widget machine. It runs its course, it is data-driven. It no longer cares if it's a green widget or a blue widget. The model runs itself and can give people the same core exposure that they already currently own in a more tax-efficient, lower volatility, and stable, emotionless approach. And with that, I'll turn it back to you, Michael. Thank you so much.
Jonathan, thank you very much. Thank you, Thomas, very much. So let's start taking some of the questions. I also want to remind everybody that there's a Q&A feature inside the Zoom toolbar. Add your questions that you have for the team. Is there a contact page on here?
If we move forward one more slide, I think we can get through our disclosures, our important information, and the next slide will be how everyone here today can reach out to the STF team. Any questions, any follow-ups, we are always around and eager to engage in a discussion.
All right, so perfect. Let's get into the questions. Can you explain the June and August performance in the funds?
Sure. So like most option writing strategies, when you're selling away upside and the market rapidly rises, it's a difficult environment in that you still met your desired outcome in generating the net credit and paying the monthly dividend, but you are short the market on the way up. And in a rules-based options overlay strategy, you have stops, no different than a hedge fund or many active managers when a position goes against them. So in June, we saw a rapidly rising market that went against the short call component, followed by a rapidly falling market. What I will highlight here, to Thomas's point about sidestepping material moves, we were only 50% equity, 50 and then 50% T-bills in June. But TUGN, for instance, was hit 2 times because of closing the short call near the highs and then participating in a measure of that pullback. What I'd like to highlight, if we went to August, again, you saw a run up and a participation on the way down. Now, I want to point to 2 things here. One is this past month's performance, where we were able to do the inverse and capture nearly all of the call premium within days of putting on the spread. And at the same token, the ability to de-risk the underlying portfolio to avoid the CPI print this week that roiled markets. So as investors could look at charts and wonder how come, say, a TUGN hasn't bounced back as quickly as a TUG. Well, when you're selling away upside, whether it's a call spread, which is better than a covered call because you are minimizing the impact of the cap on the upside, it will take some time to still recoup a, let's just say, tail risk event such as June. But what I'd really like to highlight is the fact that these products are still showing a fraction of the volatility of the equity benchmarks. They have less volatility than a 60-40 balanced portfolio. And TUGN is still paying roughly 4 times the yield that an investor could get in the Bloomberg Ag Index. So it has been a very interesting 4 months. I know that all investors have had their own challenges over the course of this past summer with the moves this year. And in no way, shape, or form is it par for the course where in 2022, we've seen over half a dozen trends of plus 10, minus 10 moves in the NASDAQ 100, which again go back to the value proposition of the TUG approach and maintaining exposure, but at reasonable risk.
Other questions?
Yeah, there's some other questions. Can you guys just look in the Q&A box? There's some questions that I'm not sure which ones you want to.
I'll take the one on the allocation to fixed income real quick here. So our fixed income side of the house is very simple. When we look at the allocation of TUG to being 100% long, 50% long, or 10% long, that's what's doing most of the work. Our fixed income side of the house is essentially designed to do some hiding out. And more importantly, it's generally going to find itself, we tilt into the fixed income side of the house when we're in what we would perceive to be a risk-off situation. Traditionally, stocks and bonds are non-correlated in that regard. But we find ourselves this year in an event we've had correlation in the NASDAQ 100 with the 30-year note. You should basically pull up the NDX and TLT as an example. And that correlation extends well back into 2021. So our fixed income side of the house is always treasuries. And in an inflationary environment like we find ourselves in now, we seek to reduce our duration. And so we hold 1 years at this moment in time. So our 90-10 positioning today is 90% 1-year notes, 10% the NASDAQ 100. In a deflationary environment, we would then go to the other end of the curve. We would now hold 30s, and we would basically hide out with everybody else in yield as a deflationary environment occurs. So our fixed income is all government. It is either 30s or 1s. And again, it really is just as simple as determining whether we're in an inflationary or deflationary environment.
Okay. Next question is, TUG and TUGN have relatively short track records. Why should I trust investing in a brand new fund?
Good. That's a good question. Jonathan mentioned this actually during the presentation. These are new, obviously launched in toward the end of May. And so from a wrapper perspective, from a product perspective, yes, they are relatively new. But from the underlying, what makes them up is not new in any way, shape, or form. The TUG model was built back in 2014 and has run both SMAs and 40 Act products since then, and has managed hundreds of millions of dollars. Jonathan, as you know, and as you introduced him, has been running these ETF with the options income components for a decade. And so again, the analogy that we'd like to go off and use is that there was a moment in time when somebody who had created spaghetti and had sold it successfully, and it was a delicious product, and somebody next door to them had been selling meatballs for a long time, decided we ought to put spaghetti and meatballs on the same plate. And so, yes, something new occurred in the sense that we now have a new product, spaghetti and meatballs, but they have existed independently of each other and to great success long before they were simply plated together and served to the public. So I hope that answers that question.
It definitely answers the question. And yeah, you guys have a very successful track record of managing money on an institutional basis. So even though the fund is brand new, your experience is not. And, both of you guys have been doing this respectively with hundreds of millions of dollars, billions of dollars, and have successfully created and launched, successful products in the past, and this is just the next iteration of that. And I know this is going to be a success. Let me get back into the questions. What is the best time to invest in each of these products, and why?
I'll take this one as well, because I think let's start with the stereotypical answer, which is, of course, you should always dollar cost average into anything that has, some volatility to take advantage of that fact. But there is something additional especially with the TUG end product and with the TUG allocation, the results of the TUG model. As I've stated, we are in our maximum defensive position right now. So by definition, we are in the mode of trying to do what you would expect in this environment, which is just to preserve capital and to eliminate as much as possible volatility of the price at that moment in time. So this is a great time to jump into TUG from that perspective, because you're taking very little risk. We're not 100% exposed to the NASDAQ 100, and you would expect that our maximum drawdowns are going to occur in events where we are exposed to the underlying index, especially at 100%. So this is a good time from that perspective. Second, Jonathan mentioned too that we put on our options program at the third week of the month. That is coming up. And so again, we'll be in a position here very shortly to generate our next premium and to have the distribution. And so again, this is a time to get started in it, because if you go ahead and pull the trigger now, you have a chance to participate in the income that's coming up here in the month of September. And you're getting it in at a relatively great allocation perspective.
All right, great. Thank you very much for that. Another question. Can you guys also look through, I don't know which ones of these you want to take and which ones you don't, but I got more questions that, if you want, I'll just select some of them, or...
Yeah, I think Mark Elliott's question for Jonathan would be good, if you want to read that to Jonathan.
Sure. So,
I got it. Oh, good.
So Mark Elliott's basically saying, I'm intrigued by your purchase out of the money calls on the NASDAQ 100 and the TUGN. Intuitively, this seems to make sense, but do you have statistical information on how this benefits the ETF?
The answer is yes. The catch-22 is that since it's an ETF, we can only show ETF specific live data. But how did we get to selling a call spread on the NDX in this wrapper, I think is a good point to hit. So the phase one of the ETF experiment was just a passive covered call. In a industry that did not have a lot of options-oriented strategies. Investor and advisor and platform commentary over the course of, say, 5 or 6 years led to phase two, which was you're paying a great yield, but can you use some of that to give me a measure of downside protection? And the rationale behind that is that the core flaw in any buy right strategy is not necessarily that your upside's capped, it's that you have near unlimited downside. And then once you've participated in that downside, it can take potentially forever to recoup your initial principal balance. So as we get to phase three with TUG, the ability to de-risk within the underlying, i.e. where the portfolio is positioned today in 90% T-bills, 10% NASDAQ, you no longer need to incur that cost to carry for that protection. So what can you benefit from knowing that your upside is potentially capped in a rapidly rising market? Well, a call spread where the legs are treated independently, where now you can potentially recoup any liability lost on the short call and or potentially participate in a drawn out move higher, given that your downside risk is already covered by the TUG approach. So that's really how the evolution of the option-based ETF has gotten us to this point. And over time, a fully financed upside call that's cheaper, that's out of the money, will benefit the fund over time, or the strategy over time. We are at a disadvantage that we only have 3 or 4 months of price activity to showcase to this group. But we are confident that over time, these strategies that have worked over the past 1, 2, 3 decades will continue to provide an investment experience that's desirable for our clients.
Mike, I'm going to take Robert Moore's question. Is TUG a trend following algorithm? And the reason I'm going to take it is because he threw in the word transparency here. A little more transparency would be helpful. I think that is great, given the name of the firm, STF, and we love that word, transparency. Yes, it is essentially a trend following algorithm, or a momentum algorithm, if you want to go off and look at it from that perspective. We basically have a handful of common and uncommon moving averages that we look at, and then a handful of relationships. But at the end of the day, the thing that's most interesting about TUG is its simplicity. There are not a lot of rules in TUG. It has been a very stable system. We had one of the differences with the ETF side of the house, again, is that as we seek to provide the tax efficiency that is inherent in the ETF structure, reducing our number of trades is actually something that's quite important. And so one of the things that we did is we launched the products. We went back, we took a look at some of the underlying assumptions of how TUG was using its fixed income position. And in the past, it's always wanted to dip into its fixed income position as often as possible. With this new approach, and again, this focus on making this tax efficient, we basically were able to go off and very quickly and simply sit there and say, we would like to reduce or eliminate as many of those trades as possible. And again, that's the beautiful thing about having something that's very simple. You know exactly when it's going to work. You know exactly when it's not going to work. And it was easy to adapt the existing rules to the ETF world. So yes, momentum, yes, trend following. From all that perspective, TUG is not predictive in any way, shape, or form. It is, in fact, completely reactive. So if that's the definition that helps you to understand, then I think that's as good a nomenclature as any. And Michael, I have one question for you that I think would be good. They mentioned too what the link is for the where the presentation is. Maybe somebody new to your website, and you might want to show them how they can get a copy of not just our presentation, but an article and our fact sheets that Jonathan referenced in the presentation at the end of this conversation.
Absolutely. So I'll be sending out an email with the recording of today's session. It'll have a link to your marketplace listings for the various products. It'll have a way to get in contact with the team here. And when you guys are done presenting, I will show people where to access it on the flyer site. So, what other indexes will you guys be looking at in the short term and long term?
So this kind of comes back to a prior talking point, in that the beauty of TUG is that it is underlying agnostic. So the TUG approach can be applied to any equity benchmark index, geographic location, emerging markets, EFA, ACWI. It could be applied to the Russell 2000, the Dow, the S&P. In addition to that, you could take it a step further and apply it based on sectors. So it could be applied to healthcare, financials, industrials, as well as different thematic exposures. So If we wanted to get further into the weeds, whether it be AI or new technology. So that's the great thing about the TUG approach, is that it's data driven. So this is not a one trick that's focused on the NASDAQ. The reason that it happens to be the NASDAQ is that is how legacy strategies with TUG were managed. And in a very coincidental fashion, the prior products, core products that I had launched and managed also had NASDAQ underlying. So this just made the most sense as the jump off point for STF to get in the ETF industry. And we are very excited about what the next 6 to 12 months look like to bring additional solutions to the marketplace that can help change the investment experience for all investors.
Okay, so you guys see there's more questions in there.
I think we got them, most of them. So one thing
I see one that might be good for Tom Munster. And how these products over the course of the last, say, decade have fit into portfolios, and how investors and advisors have utilized these as portfolio management tools to enhance their investment outcomes.
Wow. Yeah. I mean, it's been pretty broad. I would say the majority of the folks that are looking at these products are looking for income generation, and depending on age, they would use dividend reinvestment programs. If the younger person will buy the shares, each month, as the income is generated. The interesting part of it is that there hasn't been real portfolio management tools when you simply have index linked income. So this particular couple of ETFs should actually have even broader interest in the RIA space. I mean, you guys have driven home that this is a broker's product, whereby we should have reasonable returns over time and limited worry from the investor if we achieve our goals. So that's really, I mean, the income has been the by far the largest allocation, the use of it, and then some people have used some of the products that have sector exposure with as a little bit of downside protection. This to me is so much more than that. So I'm looking forward to hearing more as I engage with the RIAs and family offices and institutions as well. So I mean, that's really my take on everything is to get involved. As Thomas said, you just start to invest in the short term, and leg in over time, watch us perform, and continue to receive your income and reinvest.
Okay, I love it. I love it. Do you guys have any closing comments? We're 3 minutes away from closing out. Do you have any closing comments?
I have one. One of the other reasons we'd like you to go to our page and to click on the learn more and give us your information is that on a monthly basis, we put out commentary. We have a TUG Talks, which looks at the market, the that the TUG products are running against, and how the algorithm, the asset allocation, is responding to that. And then the income insights, which then goes and takes a look at what we're seeing from the options and the dividends that are being paid out. And so those are things that are, I think, very useful for you to stay in touch with what's going on with the product, and then to have some talking points as you engage with your end clients.
Okay, perfect. Jonathan, Tom, do you guys have any additional information that you want to share, concluding remarks?
Well, I just want to say thank you for the opportunity to be here with the group today, to share our passion about our vision here in reshaping and disrupting the way in which people can utilize ETFs to achieve a successful retirement, to meet their income needs, and to navigate various market environments that have only become more challenging of late and more volatile of late. And we think this is a timely solution for all investors, regardless of your age or risk profile. And we look forward to discussions and engaging with those who would like to learn more about how we can be a resource for you in your investment experience.
Awesome. So with everybody on today, you go to the Flyer website, flaia.org, and then just navigate to the marketplace. You can find it right here on the marketplace listing. So I am going to show you this additional information's available. Information about the team, about STF Management. I want to congratulate you guys on, the successful launch of TUG and TUGN and what you have been able to do in a very short amount of time. It's very, very impressive. So guys, thank you for coming on again. We look forward to having you back and doing more stuff and monitoring the performance of the fund and the growth of the firm that you guys are started.
Thank you, Michael.
Tom Munster will be following up with everybody that was on today's call. And I will also be following up and sending the recording and the links and how to get in touch with everybody. So that concludes our presentation today, ETF Forum. We thank you for tuning in. Spread the news, spread the word about these great products that you heard today. And, come back. Thank you so much for your time and your attention.
Thank you.
All right. Thank you, Michael.